Our average client, what do you think? Just call it 60, 62 years old.
Yeah.
We have these conversations and it's, I'm not taking a mortgage. And I sit and I think about it. You know, when they were in their family formation years, maybe their early 20s, they were taking out mortgages. Okay. And rates were substantially higher. And I've had these conversations with folks and they say, Logan, I remember my first mortgage was 12%. I never want to be in that situation again. And then, you know, a counter argument to that, which is, in my opinion, a horrible counter argument is, well, it's all relative because cash and CDs were paying 7 or 8% at the time. Making up these numbers. They didn't have any money to invest though, Dean.
Right.
And now it's on that flip side of, wow, I wish when my mortgage was 12% and CDs were paying 8 and I have this money now. And that's why from a psychological standpoint, it's so hard for them.
Starting your route to retirement.
Hello, everybody. I'm Dean Barber, founder and CEO of Barber Financial Group, your host of the Guided Retirement Show. Logan DeGraeve, certified financial planner here at Barber Financial Group, joins me today for a very interesting discussion on debt and leverage. What you're going to discover through our conversation today is that there is good debt and there is bad debt. There's debt that you want to avoid, and there's debt that you actually want to take on. Please enjoy my conversation with Logan DeGraeve, certified financial planner at Barber Financial Group. Logan DeGraeve, certified financial planner, Barber Financial Group. Welcome back to the Guided Retirement Show. Is this your first episode on the Guided Retirement Show?
I think so. Just a radio appearance. Haven't made the podcast yet. So.
Well, now you're here. You're here on the Guided Retirement Show. And by the way, what Logan's talking about for the radio appearance is we also have a radio program that you can actually pick up on your favorite podcast app. It's a different cadence, it's different topics and things like that, but that show's been going on for almost 20 years. Logan, today we want to talk about debt and leverage. And so I say there's good debt and there's bad debt. And it depends on the stage of life a person's in, whether they are going to carry debt or whether they're not going to carry debt. And I don't necessarily subscribe to the Dave Ramsey theory that all debt is bad. What do you think as a certified financial planner? Are there appropriate times to carry debt? And then we can start talking about what some of those appropriate times to carry debt are.
Absolutely, there's appropriate times to carry debt. Think about where interest rates are right now.
I call it free money right now.
Pretty much, right? Not free, but close. And it's such a psychological thing. And I always tell people, you see it all the time. We can have the best idea in the world, but if our client's not comfortable with it, it's a horrible idea. But it's our job to give them options. And you say good debt, bad debt. Yeah, it is good debt and bad debt. But at the end of the day, are you really in debt if you can go to the bank, get a check, or take an IRA distribution and pay off your debt?
Right. So what you're talking about is looking at your total net worth, right? Assets minus liabilities. Your net worth won't change if you take an asset and pay off a liability. You're still going to have the exact same net worth. So yes, you're in debt, but it's not really affecting your net worth, right?
Yeah, let's talk about a time when debt may be good. And it's what you and I deal with on a daily basis and have for a long time. We work with a lot of retirees and we deal with a lot of second homes. Right? We want to get our house in Florida, Arizona, wherever it may be, whatever's important to them. And then they say, well, Dean, Logan, I need $300,000.
I'm going to pay cash for that house.
I'm going to pay cash. And we say, well, you need a lot more than $300,000. And why is that, Dean?
Well, because most of the time, most of people's assets are in qualified plans. They're IRAs or 401ks. And so in order to net $300,000, they've got to take enough out to pay the tax on that to net down to the $300,000.
Oh, and by the way, depending on their age, then their Medicare premiums are going to go up as well.
Right. Here's the way I look at a second home, Logan, and I'd be anxious to get your take on this. But the way I look at a second home, I'll give you an example of a client that I worked with. He's been a client of mine for a number of years, loves going up to Wisconsin for the summer times. He and his wife will go up and they'll rent a place, and they'll rent a place for 2 months, sometimes 3 months, and they got a lot of family up there. So he's like, well, I think I really want to buy a place up there. And I'm like, okay. He goes, but I don't want a mortgage. And I'm like, no, just hold on a second, okay? Just hold on a second, because now this is a guy who most of his money is in traditional IRA. He's got a good amount in some Roth IRA. So we could pull the money out of the Roth IRA, no taxes due, and he could pay it off. But I asked him, I said, okay, you're 67 years old. How much longer do you believe that you and your wife will really want to go and spend 3 months in Wisconsin over the summer? How much longer do you think that you're going to have the physical ability to do it, the mental capacity to do it? Is it 10 years? Is it 15 years? Is it 30 years? He goes, well, it's certainly not 30 years, maybe 15. That takes me up to 82. And yeah, by that point in time, you're right. I probably won't want to be driving back and forth. And I said, all right, so let's take a look at the scenario. We looked at a 20% down payment to avoid PMI. We looked at what would his mortgage payment be, how much would we need to take out of his investments on an annual basis in order to make the mortgage payment, so it becomes a net zero as far as cash flow goes, right? Yeah. And what's still owed on the house in 15 years. And I'm like, look, you're going to sell this place in 15 years anyway. And if there's a little bit of debt on it, well, what it worked out to be, Logan, was we figured out that his investments could actually earn enough. We needed to earn about 5% on his investments over that 15-year period, 5% per year, for him to be able to make the mortgage payment, have a net cost of zero as far as his cash flow goes. And at the end of the day, he's still got his investment, and he's got whatever equity the house may have built.
Absolutely.
So that's good debt.
Yeah. Well, let's talk about when that may be bad debt, though, at the same time. But you knew all that because you knew your client really well. You knew how he thought he was thinking and feeling about money in those decisions. Right. That's why we spend the time we do getting to know our clients. Another example of that, I have a client that they had enough cash, a lot of cash. And what's cash paying right now?
Zero.
0.0.
0.01,
right?
Yeah.
So, and they said, well, we like having this cash in the bank. We might invest it. And I said, well, look at the opportunity cost. If you want to go get a mortgage for 3%, do it. If not, you're going to have to invest this money because you're still losing money if you keep it in the bank and you take out a 3% mortgage.
Right.
They said, well, I guess we never really thought about that. It's a trade-off. It's opportunity cost because in your case, if you over let's say 15-year time frame, we feel pretty comfortable getting a 5% return.
Absolutely. I mean, we can build bond ladders that are going to deliver that, and where we know it's predictable, right? And we can say this is what's going to happen.
And that guy, may have saved a good amount. You compound 2%, right? You're making 5, your interest rate's 3, compound 2% over 15 years. It's a lot of money.
Yeah, you're gonna actually wind up with your investments being worth more at the end of that period than they were today. Otherwise, here's what happens. In this scenario, Logan, it's crazy because the house that he would purchase in Wisconsin, or your example, Arizona or Florida or wherever, is going to be worth exactly the same whether there's debt on it or whether there's no debt on it 15 years from now.
Absolutely.
Right? And the question is, what do you still have in your account? And when you start looking at the effect of the net worth over that period of time by not paying cash and by using that debt, it's tremendous. The numbers are crazy.
You said he was 67.
Yeah.
You and I spent a lot of time talking about behavioral finance and a lot of different things. And it's, our average client, what do you think? Just call it 60, 62 years old.
Yeah.
We have these conversations and it's, I'm not taking a mortgage. And I sit and I think about it. When they were in their family formation years, maybe their early 20s, they were taking out mortgages, okay? And rates were substantially higher. And I've had these conversations with folks and they say, Logan, I remember my first mortgage was 12%. I never want to be in that situation again. And then, a counter argument to that, which is, in my opinion, a horrible counter argument is, well, it's all relative because cash and CDs were paying 7 or 8% at the time. Making up these numbers. They didn't have any money to invest though, Dean.
Right.
And now it's on that flip side of, wow, I wish when my mortgage was 12% and CDs were paying 8 and I have this money now. And that's why from a psychological standpoint, it's so hard for them. Now think about the flip side. Think about someone that's in their 25 and 30-year-old now, and they say they're used to debt, right? Student loans, college interest rates are as high as they've ever been. They're going to continue to be as high as they've ever been.
That's bad debt.
That's bad debt.
We got to get that thing paid off.
But to them, a mortgage, heck yeah, I want a mortgage, right? They couldn't do it without it.
Right.
But at the same time, too, going back to that 67-year-old, whether they went to college or not, maybe they never had student loans. It's just different. And it's such a psychological thing for people to wrap their head around. And that's really where you have to understand how to approach things with certain clients, because everyone thinks and feels about money differently.
I totally agree with that. And, real estate is the typical area where we will go in debt with, right? And so let's bring it back to using real estate as an investment and not just as a place to live or a vacation home. And let's talk about debt there versus debt on a property that you're going to use. Mm-hmm. So what happened in the Great Recession was a tragedy for many people. It was a tragedy for homeowners. It was a tragedy for real estate investors. It was a tragedy for real estate developers. And the biggest reason that it was a tragedy for all of those people is because they misused the debt. They misused it. Do you remember, and you may not, Logan, but so in 2007, I remember, this is back when I still took the Kansas City Star. And for those of you that are listening to us in another part of the country, we live in Kansas City. But I still took the Kansas City Star. I remember walking out on a snowy morning. This was the end of 2007. It was December. I walk out into the snowy front yard. I pick up my Kansas City Star. I go in. I've got my cup of coffee. I'm sitting in front of the fireplace. And I open up the business section of the Kansas City Star, and I see this full-page ad from Pulte Homes. And the ad was, you get a free BMW with the purchase of a Pulte home. And I'm gone. I told my wife, I said, the madness has gotten to a point where it's.
But you went and bought it. Did you go buy a home though?
No. I'm like, this is the craziest thing I've ever seen. And in the years leading up to that, you could, on television or radio or wherever, you'd see and hear ads. Hey, if you've got a home, we'll loan you up to 120% of the value of your home. You can use that money to take a vacation, to pay off a vehicle, to do what? And it's like, what in the world? Now, that was just absolutely insane. They had these loans, Logan, that were 5-year balloons at a low interest rate. And people were speculating, let's go take this 5-year balloon loan out. I can pay interest only on that loan for 5 years. And it's into 5 years. Just think about how fast real estate's appreciating in value. I can pay that. I can refinance and I can be in great shape.
Same thing today, though. And you and I spend a ton of time with a lot of clients' kids. And it's, how much home can I afford? And you can look online, the banker is going to tell you, you can afford whatever based off their formula. And, as a CFP, Certified Financial Planner, there's certain thresholds that we look at, but really it's, what are you comfortable with? It's not, hey, I remember when I got pre-qualified for my home, it's, hey, you can spend X, Y, and Z. And it's, I'm never going to buy a house that's that expensive. But if you don't have an education in finance and you really haven't done the research and thought about it, it would be easy to fall in that trap.
It is easy to fall in that trap. And so that's where I was going with that story, Logan, is so let's just say that you were out and you're saying, okay, this is a good deal. I'm going to go out and buy some rental properties, and I'm going to do this investment property, and I'm going to put zero down, and I'm going to do an interest-only loan, and this thing's going to positive cash flow day one because the interest-only loans are so cheap, right? And then in 5 years, think about what this real estate's going to be worth. And so here's the problem. Let's just use an example of somebody putting 10% down on a investment property. So I got a $1 million property. I put $100,000 down. Okay. That property increases in value by 10%. my property's now worth $1.1 million. What's my return on the $100,000 investment? It's double, right? I just made 100% because now I have $200,000 in equity if I sold that home, and all I put in was $100,000. So the greed factor in people as they start looking at that, it's like, oh my God, this is what leverage can do for me. This is what debt can do for me. But the flip side of that is also true. What happens if that piece of real estate that I paid $1 million for and I put $100,000 down decreases in value by 10%? How much of my $100,000 did I lose? 100%. Okay. So now a 10% drop in that real estate value wipes out 100% of my equity. And what happened during the Great Recession was people were levering themselves up so much that 10% or that 15% drop in value, it wiped out 100% of their equity or even more. And then when they go to try to refinance after the Great Recession, what did they say? You know what you got to do? You got to put some more money down, brother.
Let's think about this though, because a parallel to that may not be a popular opinion, but do you remember, let's say 3-4 years ago, about this time when Bitcoin, it was the first big bump, right? It went from couple thousand to $20,000 or whatever.
Right.
And I can remember on CNBC reading headlines of people are doing cash out refinances on their homes
and buying Bitcoin.
And then what happened to Bitcoin shortly after that?
It crashed.
And now it's back up.
But yeah.
But could you have withstood the crash? Most of the people that are taking out cash out refis to do that? Probably not.
Right.
So same kind of dynamic. It's the same thing with margin on investment accounts.
Speaking of margin on investment accounts, so there's a good time to use a margin, and then there's a bad time to use margin. I want to take our listeners and our viewers all the way back to the Great Depression. So do you remember people saying that they literally lost the shirt off their back? So at that point in time, you were able to margin almost anything to invest in the stock market.
Yeah.
You could margin your house, you could margin your car, you could margin any asset that you had that you would pledge to the brokerage firm, you could margin it. And when the markets drop, you get a margin call, they're coming collecting on everything, right? That's horrible idea. They've since put rules in place where there's only a certain percentage that you can margin in your brokerage account. But let's take another example of when a margin might have been a good idea. Now, this is an aggressive move. This is an aggressive move, not something that I recommend for most people. But let's say that we went back. Let's go back to COVID, February, March of 2020.
Okay.
February, March of 2020, COVID hits. And what happened to energy stocks? They were cut in half or more in a matter of 2 or 3 weeks. Okay? So now you might step back and ask yourself a question. Are we going to stop using oil? Are these energy companies going to remain at this level for a prolonged period of time? And so is COVID going to go away at some point and we'll get back to kind of normal things, right? So at that point in time, you might have looked and said, hey, I got some money in my brokerage account. Maybe I should borrow a little bit and buy some of these really, really cheap energy stocks because it was evident at that time. I mean, I think BP was a perfect example, got down to $15 a share. It was $60 a share before COVID hit. Now it's back up to 25 and some change.
And the beautiful thing about that, you said brokerage account. And at the same time, I don't care what you held, it was down. So why would you take margin? Well, because you don't want to sell what you at things at losses.
Right.
Think about if you had Southwest Airlines. That wasn't recovering anytime soon.
But it did. It did. Think about Las Vegas Sands or any of the other.
But you would never have sold that
brand
to get the funds needed in order to buy, in your example, the energy stock.
Oh, so let's go borrow some money against the equity that we have in the position because we know that things are depressed for a temporary time. And I think one of the things that happens there, Logan, is that a lot of times people, they don't understand the depth of which a stock can fall. people think, oh my gosh, this thing's going to go to zero. I'm going to lose it all. You and I, as financial professionals, can look at it and say, okay, here's the real dynamics behind this. This is the financials that the company has. Here's what their longer term outlook is. This is a bargain.
Their financials didn't get 35% worse because overnight. It was COVID, right? Fear. Let's talk about something else. And this is when a lot of our viewers are thinking about debt, and it's not good debt, it's credit card debt. Okay? And when you're sitting down on a financial plan,
never do that one. That's
the worst one you can do. And I have people all the time that say, well, I just want to make my minimum payments. That's not what we want to do.
No.
So if you're someone that may be in credit card debt that's listening, it happens, okay?
You got to get that paid off.
Got to get that paid off fast, okay? And look at which rates are the highest and pay those first. Example of that, though, and where I wanted to go with this is credit card companies aren't stupid. What do? They give you, no APR for 12 months, right?
Take it.
15 months. Take it. But you better make sure that
you're going to get that thing paid off.
You have that thing paid off in time, because a client of mine's son came in and they go, I got into trouble. I go, okay, what kind of trouble? It's like, well, I have a no APR card and I maxed it out. And I go, okay. I was like, what's the time frame? Let's figure out a payment plan to get it done. He goes, yeah, that was ended last month, and now it's at 21%. So it's not just credit cards, but there's a lot of things out there where it's no interest. And a guy like you and I, we look at that and we say, look in our chops. We want no interest.
No brainer.
It's great. I'll use free money all day long.
You go to Nebraska Furniture Mart. You go to the car dealership, right? I mean, now I will tell you a story. So I bought a new vehicle a couple of years ago, and they had a 0% APR. Okay, so no interest. And then I said, but what's the price of the car if I pay cash? Okay. And so they give me a different price if I pay cash. And I'm like, okay, well, do you have other financing options that I could get the same price for cash? Right. And I said, yeah, 2.9. And I said, how long do I have to carry that loan for this reduced price at the 2.9% APR? They said, you have an early payment penalty if you pay it off within 3 months. And I said, okay. So I took the loan for 3 months. I saved like $5,000 on the vehicle at 2.9% for 3 months, and then I paid the freaking loan off. That's a no-brainer.
But one reason you were able to do that, though, you have good credit. And that's a whole part of this whole conversation we're having, too, is how important it is to have good credit. So, for instance, you made an example of Nebraska Furniture Mart. 3 or 4 years ago, when I furnished my new home, 0% on everything, right? TVs, bedding, all that. Why wouldn't I do that? Now, they have certain credit threshold.
You wouldn't do it unless you knew you could pay it off in the period, because you got to pay that thing off within like 12 months or 13 months or 15 months or whatever. You got to make sure that you got the cash to do that.
And that all goes back to discipline, though.
Yeah.
It's the whole thing with debt and leverage. I think if there's one word that describes if you're going to use it or not, it's, are you disciplined? Can you put yourself a budget together to get this done? It doesn't matter what it is. But my example with that was you had to have above a certain credit score to do it. And that's what people don't understand of how important credit is. You and I talk with our clients all the time about, hey, put your kids on your credit cards, right? Start building credit for them early on.
Right.
Don't let them have a credit card until they're making good financial decisions. But credit and the value of good credit, because once it's not good and you've had some issues, it's very, very hard to come back from. And then you're not having the same type of luxuries that you're describing with the cars and those type of things.
And on the flip side of that, Logan, think about what some of the credit card companies do. They will give you cash back. They will give you points towards certain things.
There's people that make careers writing about, hey, you can get this credit card this month if you have good credit, and then you cancel it. Now, that's a lot of work. I'm not going to go do that. You're probably not going to go do that, but it's powerful.
But I will tell you this. I have not paid for an airline ticket in probably 10 years.
That means you spend too much money.
No, I just don't. I don't pay for airline tickets. I fly my kids where I want to go. I fly, my wife where I want to go. Because what I did was I went out and got a Southwest Visa, and I got a high enough credit limit. And I literally put every single thing that I can on that card. Why do I do that? Because I like to travel. I like to do things. I like to be able to bring my kids along. And if I put all of these expenses on the credit card. Now, by the way, I pay that thing off in full every single month. I never, ever have been charged one penny of interest on this credit card. But by using that credit card, I am now flying all the time with no cost. I'm flying my kids with no cost. And
your cost would be huge if you were flying the kids and significant others.
Right. I mean, so that to me, I don't consider that debt. I consider it a different way to pay for things.
Good point. And I preach this often is I tell everyone, I don't care how old you are. If you have a job, put things on a credit card, one for the perks and points, but more importantly, and I see this with clients all the time, is, well, we got $15,000, maybe it was a small inheritance, and it's just sitting in our checking account. And I say, move that from your checking account now. That's your money, okay? Someone gets your debit card, online scams, it's prevalent every single day now. Credit card, that's the credit card company's money, okay? So why would you ever leave your money at risk like that? It just doesn't make sense for me. Now, if you have the inability to control spending,
even no discipline.
No discipline, right? Going back to that word, it makes sense to use a debit card, okay?
Right.
But as long as you have discipline it's not that hard now. You can set it all on auto pay. And then as long as the money's in there, you don't have to worry about it. That's something that I do see though with some of our older clients is they just don't think about it because they say, I don't like credit cards. Why?
Right. And I have another credit card that I use an awful lot, and that's my Cabela's card. I love to hunt. I love to shoot. That's been a avid hobby of mine ever since I can remember. My grandfather taught me to start shooting at 9 years old, and so that's something I do. So I use my Cabela's credit card from time to time, and what do I get from that? I get points at Cabela's or Bass Pros, and so then all of a sudden, when I want to go in and I need to buy some ammo, or I want to buy something for my fishing boat or whatever, the money's there. It's already in the points within the system. And again, I pay it off at the end of every month, so I don't have to worry about ever paying any interest on it.
Let's talk about something we've kind of talked about but maybe glossed over that you and I have been doing a ton of the last couple of years. And let's say COVID timeframe. Cash out refis on houses. Okay, someone comes to you and they say, hey, let's just use a second home example. Hey, I have, this dream house that came up. I worked on a case with a client, but hey, we're going to have to take about $100,000 out for the down payment. We don't have that. It's going to have to come out of our investments. And oh, by the way, Logan, we're not 59.5, or we can't touch basically our 401k or IRA money.
Go take a second mortgage on your home.
And at the time they said, what? I've just spent my whole life paying this down, and now I'm going to add 100. And I mean, their rate was like 5%, and I think we got them a 3 on a 30, no brainer to begin with because they're going to stay in the home. But secondly, they could not accomplish that retirement goal without talking to me.
By pulling money out and paying cash and then paying the 10% penalty.
Taxes, 10% penalty.
Yeah.
And you're taking, when you're still in that accumulation phase of life, compound interest is your friend. The hardest part is just getting enough money in there to start compounding.
Yeah, I think it's interesting because a lot of people confuse the dollar amount on their IRA statement and the dollar amount on their 401k statement with how much money they have. I promise you that the values on those statements is not how much money you have. And the way I want to illustrate that to you is go try to cash that out and spend that amount of money. You've got $1 million in your 401k, beautiful, congratulations. But if you really think you have $1 million in there that you can spend, try to take that $1 million out and go spend it. You can't do it.
So I'll probably sit down with 100, 120 new people a year. Probably a good ballpark. In the last, I would say, say 8-10 years. I've seen it once. A gentleman came in and his 401, let's call it $1 million, okay? And he goes minus whatever, and he said, well, I got about $700,000 in my 401k. I go, well, the statement says $1 million. He goes, yeah, but all that money's not mine. And I just shook his hand on the spot. I go, you get it. You get it. But where I wanted to go with that cash out refi story was talk to a financial planner and figure out if you have a goal or dream of what you want to do. There's a lot of different ways to be able to do it, but you don't know what you don't know.
Right. There are a lot of different ways. And sometimes people can't see really what's right there in front of them, right? And that's why it's really good to reflect with a good certified financial planner like yourself, where you can step back and say, all right, tell me about everything, right? It's almost like they're going to a therapist and they're kind of laying out, here's what I really want and here's what I've got. Well, okay, here's the best way to do it.
And once you understand how they think and feel about money, you can begin to kind of frame those conversations.
Yeah.
Because I can't talk to a client about a cash out refi from one client A to B to Z, right? They're all going to take it differently and they're all going to need to ask different questions. So that's why we do a really, really good job of getting to know our clients.
That's important. I mean, because if we don't know them, then there's no way that we can do the right thing.
No, it's impossible.
So Logan, I think that the bottom line here when we come to debt and leverage is there is a good, there is a bad. There is no book that can tell you what's good debt for you, what's bad debt for you, when you should use leverage, when you should not use leverage. It has to do with your own personal financial situation. And one of the things that I think that we're doing here at Barber Financial Group that's different than the majority of the industry is that I think a lot of people think, well, if I go talk to somebody in the financial world, they're going to try to sell me something, right? And that's, so you as a certified financial planner, you're not selling anybody anything. You're saying, okay, what do you have going on? Let's see if we can give you the great advice. So in the eyes of the public, they need to look at you in the same lens as they would look at a CPA. I need somebody who has some expertise in this area. Now, do you do it for free? Absolutely not. Nobody in this country works for free, right? So if you're going to sit down and you're going to do an analysis and you're going to say, okay, here's what you can do. Most of the time, you're going to gather enough information to say, you know what, doesn't make any sense for you to pay me, or you know what, I know enough in a very brief conversation, 15 to 30 minutes, that it's going to be worth it for you to pay my fee.
And what we're doing too that's different than a lot of folks is we're sitting down with our CPAs in-house and we're looking at these decisions together.
Yeah. Powerful stuff.
It really is. And I don't think you can do it on your own. Maybe.
Well, some people can, Logan, but I think that the issue is that
the picture's too close.
It is.
You got to have someone that kind of pulls it back for you.
It is. It's too close. I'm going to give a perfect example, and we'll end our podcast on this quick story. I don't think I've ever told you this story. So had a gentleman come in to me back in 2009 or 10, I believe it was, and we had been on America's Wealth Management Show, the radio program that I talked about at the beginning of the podcast, been talking about tax planning and been talking about how we can help people reduce their long-term tax liability. And we gave out an opportunity for people to come in and, hey, let's have a free look. Let's take a look and see what you're doing and see if there's anything we can do to help. So this guy comes in and he brings 2 years worth of tax returns and he lays them in front of me and he says, I want to know how you can do better than this. Well, his tax liability for the prior 2 years was zero.
May not be a good thing.
It was zero. Okay. So I said, congratulations on paying no taxes, but can I ask how you're living? How are you paying your bills? And he said, I've got a bunch of money set aside in the bank and I'm spending that right now before I start claiming my Social Security in a couple of years. And I'm like, okay, that makes total sense. I said, but do you not have any money in IRAs? And he goes, oh yeah, I got a couple of $1 million in IRAs. And I said,
how old was he?
He was 60 at the time.
Okay.
And I said, so when you talked to your CPA and they told you, based on what I see on your tax return, that you could have taken almost $30,000 out of that IRA with zero taxes due. Was there a reason you didn't do it? And he just looked at me and he said, well, we never had that conversation. And I said, so when your CPA explained to you that you could have taken $95,000 out of that IRA and you could have converted it to a Roth IRA for a total tax of $11,000, is there a reason why you didn't do that? And he goes, well, we didn't have that conversation. I said, why not? He said, because my CPA doesn't know I have $2 million in my IRA. So what
that's common.
I know. So what was happening was he was taking his standard deductions and personal exemptions, and he had a negative taxable income where if he would have done a couple of these really simple things that you and I would see in an instant, he could have gotten money out of those IRA accounts, almost $200,000 at about a 12% tax rate, put it in a tax-free environment where it could have been tax-free forever. It's crazy.
But it's more common than you think.
It is very common, right? And the reason that happened is because his taxpayer or tax preparer at the time, he never asked any questions.
It was tax compliance.
That's all it is. I was preparing the tax return based on what the guy gave me.
I honestly believe being a certified financial planner and the environment that we have here and the tools with the subject matter experts, right? Estate planning, insurance, tax. It's my job to play quarterback for my clients.
100%.
And it's my job to coordinate with all these Joanne, right, estate planning attorneys, because ultimately, if you forget one piece, it can blow up the whole financial plan. As little as it is, your property and casualty insurance, if it's not done right and something happens,
it can blow it up.
Absolutely.
So we got a little bit off the subject of debt and leverage, but you know what? The whole deal revolves around your overall financial plan, and that's why we use our guided retirement system, and that's why we have the Guided Retirement Show. Logan, thanks so much for taking time out of your busy schedule to join me here on the Guided Retirement Show. Pleasure to have you here. I'm sure we'll have you back many more times in the future.
Appreciate it, Dean. Had a good time.
Thanks so much for joining us here on the Guided Retirement Show with Logan DeGraeve, Certified Financial Planner. If you're watching us on YouTube, make sure give us a thumbs up and subscribe to our YouTube channel. Also, I would love for you to start a dialogue with Logan right here on the Guided Retirement Show. So if you'll type in your comments, he'll be able to reply back to you. If you'd like to schedule a time to visit with Logan personally, he can do that through a phone call. He can do that through a virtual meeting or in person. All you've got to do is click a link in the show notes to see his schedule. Thanks for joining us.
Starting your route to retirement.